Hi guys, this is Dayo. Today we are going to be talking about market structure. As we all know, market structure is the dynamic movement of the market. Um, it can also be defined as the behavior of the market. We say the market usually moves in an uptrend for those that are not beginners. For those that are not beginners, you should know this already. But for beginners, we see the market moves in an upwards direction and also moves in a downwards direction. So it moves upwards and it moves downwards. So when it moves upwards, we call it an uptrend, and when it moves downwards, we call it a downtrend. So normally, when the market moves, it creates. I'm coming. When the market moves in an uptrend, let's start with uptrend. When the market moves in an uptrend, it creates a series of higher highs, higher lows, then higher highs again, then higher lows, then higher highs and higher lows, and so on and so forth. So this is how the market moves. It moves, it goes up and goes down again and still goes up. So when you see patterns like this, it's called an uptrend pattern, or it's called a bullish trend. So whenever I say a bullish trend, that means the market is going upwards, and whenever I say a bearish trend, that means the market is going downwards. So whenever the market is going, I'm coming. So whenever the market is going downwards, we say whenever the market is going downwards, we say the market is creating series of lower highs, lower highs, lower lows, lower highs, lower lows, lower highs and lower lows. This is how the market behaves. So the market cannot just go down straight downwards. It has to go up, then go down. It has to go up, then go down. That's how the dynamics of the market is. That's how the market moves. So let's go back to our uptrend. I'm trying to kill two birds with one stone. So in an uptrend scenario, whenever a higher high is created, let me write something. This is our higher high. 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 Then this is our higher lows. This is our higher lows down here. Higher low. So I don't know. I think I'll just be signifying it as I'll just be indicating it as HH and HL, just in case you see HH and HL, it means higher high and higher lows. So let me just increase the font size. So it goes up then goes down, goes up then goes down. So when it creates a higher high, it has to go down then create another higher high. So when the market goes up to create another higher high, the previous higher high is taken out. The previous higher high is taken out, and this scenario is called break of structure. Break of structure. So we call it BOS, we call it break of structure. It really depends on your personal preference, but for short we call it break of structure. We call it BOS. So I'm going to be indicating it here. So this um interval between the higher high and a new higher high is what we call the break of structure. So when the market creates a new higher high, um rendering the previous higher high um useless. You get? So the previous higher high has now been replaced with a new higher high. So the scenario of creating a new higher high is called break of structure. Same thing goes to the downtrend. Same thing goes to the downtrend. I'm just going to brush over. I'm still going to be dropping another tutorial to explain further, to explain more on this on these things. So when the market creates a new high, a new lower high, and creates a new lower low, when the market creates a new lower high and creates a new lower low, the I'm coming. Sorry. The new the previous higher high has been rendered um mitigated, has been we call it mitigate. Some call it mitigation, some call it invalidation, but yes, it has been mitigated, which means it has been replaced, or it has been occupied by another lower high. So for instance, now this is our lower. I'm coming. This is our lower low. This is our lower high, lower low. So this lower low, when this lower low is replaced by another lower low, it's called break of structure. Same thing goes to this. When this lower low it's being replaced by another lower low, it's called break of structure. Same thing goes to this, same thing goes to. So this is how it works. This is how it works. So yes, this is just as simple as that. So when the market moves, and again, I'm still going to be talking about um internal liquidities. I'm going to be talking about internal liquidities. I'm going to be talking about external liquidities, because in as much as we see that the market moves this way, in as much as I draw and indicate that the market moves this way, it doesn't really move exactly this way, because in between this BOS that we are seeing, in between this higher high and higher low, there are what we call internal liquidities, institutional liquidities. For instance, when a series of high and higher lows take place, there are something like this inside our higher high and higher lows. Before another higher high, there has to be some series of higher highs and higher lows inside our higher high before it gives us a new higher high again. So this movement of market doesn't go straight forward. It doesn't go straight forward. It has to go down before it goes up. It has to go down before it goes up. So this is just like a brief explanation on um the basic market structure. So if you have any question, you can drop it down below, and I am still going to be expanding on this in my next video. So I don't want this video to be long, so if you enjoy this video, do well to subscribe, and I'll see you in my next video. Peace.